Some investors have turned a single property into a portfolio of 10 or more homes without ever saving up a massive down payment again. That is not a typo. And it is not some secret reserved for the ultra-wealthy. It is a repeatable system that thousands of everyday investors are using right now to build serious long-term wealth through real estate. The strategy is called BRRRR. And by the end of this video, you will understand exactly how it works. In the next 10 minutes, we are going to break down every single step of the BRRRR strategy, from what each letter actually stands for to how experienced investors are recycling the same capital over and over again to grow their portfolios faster than traditional buying ever allowed. And here is the part most people miss entirely: there is one step in this process that beginners almost always underestimate, and getting it wrong can erase every dollar of profit you thought you had made. We will tell you exactly what it is. Let us start with the basics. BRRRR stands for buy, rehab, rent, refinance, repeat. It is a real estate investment strategy that has been around in practice for decades, but it was popularized and given its now famous acronym largely by David Green and the BiggerPockets community in the mid-2010s. The concept became a cultural touchstone in the real estate investing world and has since been referenced in hundreds of books, podcasts, and investment courses. The core idea is deceptively simple. Instead of tying up your capital permanently in a single property, you recover most or all of your initial investment through a cash-out refinance after adding value, and then you use that recovered capital to do it all over again. Traditional real estate investing tells you to save up a down payment, buy a property, collect rent, and wait. That works. But it is slow. With the BRRRR method, you are not waiting. You are engineering value and extracting it, then redeploying it. That is a fundamentally different mindset, and it changes everything about how fast you can scale. Now let us walk through each step in detail. The first step is buy. This is where most investors think the work begins, but experienced BRRRR investors will tell you the deal is won or lost before you ever close on the property. You are specifically looking for distressed properties, homes that are undervalued because of cosmetic damage, deferred maintenance, or motivated sellers who need to move quickly. The goal is to purchase significantly below the property's after-repair value, which is commonly called the ARV. A general rule of thumb used by many investors is the 70% rule: do not pay more than 70% of the ARV minus your estimated repair costs. This gives you a built-in cushion for profit and refinancing. The second step is rehab. This is where you increase the property's value by making strategic improvements. And here is where a critical mistake happens all the time. Many new investors over-improve. They put granite countertops in a neighborhood where the comparable homes have laminate. They spend money on upgrades that do not translate into appraised value. The rule of thumb here is to renovate to the neighborhood standard, not above it. Focus on improvements that appraisers and the market will actually reward: kitchens, bathrooms, roof, HVAC, flooring, and curb appeal. The rehab phase is also where your timeline matters enormously, because every month the property sits under renovation is a month you are not collecting rent. The third step is rent. Once the property is rehabbed, you place a quality tenant and begin generating cash flow. This step serves two purposes. First, it validates the property as a rental asset, which makes it easier to refinance. Second, it demonstrates to lenders that the property is income producing, which can influence the terms of your refinance. Many lenders want to see a lease in place before they will move forward with a cash-out refinance on an investment property. Targeting a rental rate that meets or exceeds the 1% rule, meaning monthly rent is at least 1% of the purchase price, is a common benchmark, though market conditions vary significantly by region. The fourth step is refinance. This is the engine of the entire strategy, and it is also the step that separates successful BRRRR investors from those who get stuck. After the property is rehabbed and rented, you go to a lender and refinance based on the new appraised value of the property, not what you paid for it. If you bought a distressed home for $120,000, put $30,000 into renovations, and the property now appraises at $200,000, a lender offering a 75% loan-to-value refinance would give you a loan of $150,000. That means you could potentially pull out more than you originally invested. That is what investors mean when they talk about recycling capital. But here is what nobody talks about often enough: the refinance does not always go perfectly. Appraisals can come in lower than expected. Interest rates affect how much cash flow remains after your new mortgage payment. Seasoning requirements, which some lenders impose to make you wait 6 to 12 months before refinancing, can delay your timeline significantly. These are not reasons to avoid the strategy. They are reasons to plan carefully and build in conservative projections from the very beginning. The fifth step is repeat. Once you have recovered your capital through the refinance, you take that money and buy the next property. Each cycle ideally leaves you with a cash-flowing rental asset and most of your initial capital back in your pocket. Over time, this compounding effect can allow investors to build portfolios that would have been impossible through traditional buy-and-hold strategies alone. Let us talk real numbers for a moment. According to data compiled by BRRRR and various real estate research firms, investors who successfully execute the BRRRR strategy can achieve an infinite or near-infinite return on investment when they pull out 100% or more of their initial capital while still retaining a cash-flowing property. That concept, infinite ROI, sounds too good to be true. But mathematically, if you have $0 remaining in a deal that generates $300 per month in cash flow, your return on that $0 investment is technically unlimited. This is why the strategy has become so widely discussed in investing communities. Now for the deeper analysis. The BRRRR strategy works exceptionally well in specific market conditions and falls apart in others. Rising property values and strong rental demand create the ideal environment. But in overheated markets where distressed properties are scarce and prices are already inflated, finding deals that work on paper becomes extremely difficult. Investors in major metro areas like Los Angeles or New York City often find the numbers simply do not pencil out. Markets in the Midwest and Southeast, particularly cities like Indianapolis, Cleveland, Memphis, and Birmingham, have historically been more favorable for BRRRR investors because of lower purchase prices and consistent rental demand. Financing is another critical variable. BRRRR investors typically start with hard money loans or private money lenders to fund the purchase and rehab, since traditional banks will not finance distressed properties that are not move-in ready. Hard money loans come with higher interest rates, often 8 to 12%, and short terms, usually 6 to 12 months. This creates urgency to complete the rehab and refinance quickly. Every month of delay is costing you money on that high-interest bridge loan. Tax implications also matter. Depreciation, mortgage interest deductions, and the ability to do cost segregation studies can significantly reduce your taxable income from rental properties. Many BRRRR investors work with CPAs who specialize in real estate to maximize these benefits. This is not optional advice, it is essential. Planning if you want to preserve the wealth you are building. The most honest assessment of the BRRRR strategy is this: it is powerful, it is proven, and it is genuinely accessible to investors who are willing to do the work. But it is not passive. It requires market research, contractor relationships, accurate underwriting, and the discipline to walk away from deals that do not meet your criteria. The investors who succeed with BRRRR are not lucky. Before you go, if you learned something valuable today, hit that like button right now. Subscribe to Realty Pulse for a brand new video every single day. We will see you in the next one.